We're back. This is Ask the Compound. On today's show, we're answering questions straight from our audience about the impact of Fed rate cuts on stocks, bonds, and cash, how the process works when you take out a home equity line of credit to remodel your house, the cost-benefit trade-offs involved in life insurance or just simply investing, paying down high-interest rate debt for a home remodel versus investing in stocks, and how the step-up basis works once a spouse passes away. Or email here, askthecompoundshow@gmail.com. Remember, if you ask a question, we always love follow-ups too. Every once in a while we get a follow-up from someone saying, here's what I actually did, and here's why Ben was so right about what he said. It's amazing.
We get a lot of really good ones, yeah. Sometimes if we haven't gotten to yours, we keep them in a queue. We might get to it down the road. So
that's true. Yeah, we got a lot of questions in the backlog. Today's show is presented by Public. The Fed did not cut rates yesterday, and savers of the world rejoiced. You can still earning high yields on your cash at public.com, 5.1% APY with a high-yield cash account, no fees, zero balance requirements, no minimums, plus $5 million in FDIC insurance if you're worried about another bank run. It's 20 times the standard coverage. Public.com to learn more. And here's our disclosure for the compliance people. This is a paid endorsement for public investing. 5.1% APY as of June 17th, 2024, and is subject to change. Full disclosure in the podcast description. All right, good questions today. The good thing I like it is we have the diversification of questions. They're always kind of out of left field and stuff we haven't heard before. So I think today is similar. So let's do it.
All right. Up first today, we've got a question from Jeff. I was in the camp that the Fed wasn't going to cut rates at all in 2024. Alas, it looks like I'll be wrong, and a September or November rate cut is all but assured at this point. So what are the portfolio implications if we enter a rate cutting cycle? When should I get out of my T-bills?
So there was this guy on Twitter who all year was tagging Michael and Josh and I, like on a weekly basis, saying, my contrarian take is no Fed cuts this year. And he was almost right, because if you recall, it was like 6 Fed cuts was consensus at the beginning of the year. So this guy was taking early victory laps, and it sounds, I don't know if this is the same guy, maybe it is, but it sounds like for sure a cut in September or November, so we're going to get one, so he was wrong. But I give him credit for putting his neck out there. The Fed probably should have cut rates yesterday. If I'm stepping in for Jerome Powell, I suppose a couple months isn't going to matter all that much in the grand scheme of things. My contention is the Fed matters less to financial markets than most people assume. Sure, they have the ability to impact them in the short term when they do stuff, but Powell's not this wizard who can just pull the strings. They probably matter more so than the president does in terms of people worrying about what's going to happen, but they don't control the stock market like some people think. But the changing in interest rates can have an impact on your portfolio. So I think it's helpful to understand, what does this actually mean? So I think the reason for the Fed rate cut probably matters as much as them actually doing it. So if they cut in emergency fashion because we're going into a financial crisis like we did in 2008, that's a different story than the Fed cutting because the economy is slowing a little bit and inflation is coming back down. So I had our research guy, Matt, do a bunch of look-aheads for me. So I looked at S&P 500 going back to 1970 following the Fed's first rate cut. Okay? It's happened a bunch of times. And you can see here the average returns are pretty darn good. There's not that many times when it's been negative. 1 year later, the only times it's really happened are 1973-74 bear market, 1981 there was a recession, 2001 when the dot-com bubble blew up, and then, of course, they started cutting in 2007, which is too late for the financial crisis. 5 years later, positive every time. Only a couple times was it negative 3 years later. The win rate's pretty good, too. We're talking like 83% of the time stocks were up 3 years later, 72% 1 year later, 100% 5 years later. So it's been rare that stocks are down after the Fed cuts. Sometimes, they cut because there's a recession approaching, but that's not always the case. So if we break it down, John, next chart on, here's a look at the differences in forward returns during recession and non-recessionary situations. You can see the average returns are a little better when there's not a recession, which makes sense. It's pretty obvious, but it's not like there's that drastic of a difference. So my whole investing ethos is most of the time the stock market goes up, sometimes it goes down. That applies to Fed rate cuts as well. So I don't know. I think the stock market still cares more about earnings and the economy than they do what the Fed's doing. Obviously, everyone thought the market was going to totally fall apart when we went to 5% rates. And there was a bear market, but it wasn't this crazy crash-like situation. So where the Fed rate cuts really matter is your cash. So John, next chart on. This is 3-month T-bills against the effective Fed funds rate. And you can see they essentially are the same thing, or they track each other. So when the Fed cut rates, you will see a drop in yields on T-bills, savings accounts, money market funds, CDs, all that kind of cash and cash equivalents, as we'd like to say in the business. So holding these cash equivalents during the rate hiking cycle was an intelligent move, right? There was no interest rate risk, so you have no volatility, no nominal drawdown, and yields were actually higher because the yield curve inverted. So that was a good place to hide out when bonds were getting crushed, stocks were getting crushed. If you hung out in T-bills for a while and you got these 5% yields and you had no volatility and your only risk is inflation, you did pretty good. Longer dated bonds had massive drawdowns, right? So it's kind of been the best of both worlds. Now things are a little trickier. You have this reinvestment risk where these yields will be falling. I don't know how much the Fed's going to cut when they first start cutting. So obviously it depends on where they go. Are you going to be content to hold on to T-bills if we go from 5.5% to 4%? I think most people would still be okay. What if we get 3%? Then you're starting to get worried. So I'd say with most asset allocation decisions, like there's no right or wrong answers here. A lot of it boils down to why do you hold T-bills in the first place? Like I think there's a valid case to be made to hold T-bills in your account and bonds, and they can act as they sort of help you hedge different risks. So were you hiding out in T-bills because you were worried about bonds and now you want to get back into bonds? The thing is, the bond market doesn't wait around for the Fed. The T-bill yield will wait around for the Fed. What the Fed does, that'll impact the T-bill yield. But John, do my next one. Remember last fall, I guess it was October, I think, all of a sudden the 10-year Treasury yield shot up to 5%. And so what I've done here is I looked at from when that happened, and people were looking for all these crazy excuses. Why is this happening? Because people are worried about government debt and the government's spending too much money, and this is it. The bond market is fighting back. And ever since then, yields have come down. And you can see they've come down quite a bit on the 2-year, the 3-year, 5, 7, 10. And so the bond market is not going to wait around. They knew cuts were coming, and they move in anticipation of them. So you could say, well, I'm still locking in higher yields than I was in the past. We're talking more like 4% yields now instead of 5, maybe 4.5 if you go a little further out. So bonds have a higher margin of error for you at current levels, but if you're hoping to like score on the bond market, that move's already happened. Now that you could also say, well, I'm preparing for a recession, so I'm getting higher yields, and if there's a recession that happens in deflation or more disinflation, bonds are the place to be. So I guess the good news is this choice is a lot easier than it was a few years ago. There's higher yields to start with for bonds and cash. Even if the Fed cuts, 6 times or something, you're still going to be earning a better yield than you were in the 0% age of 2010. So I'm always a person who says you don't have to go to extremes. You don't have to put all your fixed income eggs in one basket. There can be a place for cash and cash equivalents in your portfolio as long as you understand what the pros and cons are. There's a place for bonds if you understand what the pros and cons are. It's just, I think my only advice would be to avoid trying to jump in and out of these asset classes based on your interest rate forecasts. No one has the ability to predict the direction of interest rates or the magnitude of the changes. Even the Fed, who literally sets the rates, they can't forecast what they're going to do in 3 months or 6 months. So how are you supposed to predict interest rates? So I look at these decisions through the risk-reward lens, right? Like, what's the yield I'm getting? What are the potential risks? Every investment decision requires trade-offs. The Fed rate cutting cycle is no different. So same as ever.
I have some questions, some follow-ups, and I'll preface this for our new audience. I'm a creative. I'm not a financial professional. So, but my question is, when they were when they were bringing up rates, it killed a bunch of like tech stocks and smaller, small caps, companies that were relying on a lot of debt. So wouldn't this now be a catalyst in the opposite direction? But everything's selling off in preparation. So help me make sense of that.
Yeah, no, that would make most small caps have, like we said last week, skyrocketed in the last few weeks, and I think that's the move ahead of that is if rates fall.
But everything's red today after signaling.
Duncan, we don't look into one day's performance. Okay, yesterday was up big, today is down. Like,
I just want to know why I'm down so much today, Ben.
Okay, you can't make a conclusion based on one day of performance, right? Okay. You have to look at a year or two worth of Oatly being down 95%. Now that's a trend. But we don't look at one day and make decisions, and here's the conclusions that you draw. The market, who knows what they're thinking.
You've been looking at Oatly. That's almost exactly what it's down. So yeah, you've been checking it out, I can tell.
But yeah, no, that in theory. So, but the question is, are rates falling because we're normalizing, or are rates falling because the economy is slowing? That's the next argument. People are going to very quickly Remember 2 or 3 months ago, people were saying 1970s, stagflation, higher for longer. Apparently, it was higher for 3 months. Because now the arguments are going to be, wait, labor market's cooling off. Why is the Fed cutting? Is it because recession? Is it because deflation? Is it because things are slowing? That's where the arguments are going to be going now.
Yeah, it feels a little bit like choose your own adventure. And to someone like me that's not a finance professional, it's very confusing.
Yeah, as always. But
Okay,
hopefully lower borrowing rates and probably lower yields for savers. That's the only thing I can say with certainty.
Okay, got it. And so what should people buy? I'm just kidding. Okay, question 2, we have a question from John. We purchased our forever home back in 2022. It needed a lot of major work, which we did for the first year before we moved in. The house is in a fantastic neighborhood. The home value on the county auditor's website is our purchase price and appears by every comparison I can find to be roughly $250,000 under what it's actually worth. We purchased it for $325,000 with 20% down. The comps and Zillow put it at about $575,000. I know you've talked about using HELOCs once rates come down, and we were thinking about doing this for the last 2 bedrooms we want to renovate. My question is, when does it matter if your home is accurately valued, and should we have an appraisal done in anticipation of a HELOC? Is there any advantage to getting a HELOC now and waiting to use it? We have no debt other than our mortgage.
Good question. I've gone through the HELOC process 2 to 3 times. We took out a home equity line of credit early on in the pandemic, before real estate really took off. I was going to use it to buy stocks in early 2020. We could rewind the tape on Animal Spirits, and that's on record. But the process took longer than I expected. The stock market got away from us, alas. But then housing prices went bonkers, and so we had more equity in our home. So I went back to the bank and said, hey, here's how much you gave me the first time because of how much equity we had. Can I double it now because our house is worth so much more? And they said, yeah, just go through the process again. And so I use a credit union, a local one, for my mortgage. The process might be a little different than they use for big banks, but I'll share what my experience has been like and what I think this person should do. So the cost is somewhere $250 to $500. Maybe bigger banks charge more fees. So it's not a huge expense to have this done, and it's not like refinancing where they just bend you over and ask for paperwork for months on end. They will ask for some paperwork, probably, maybe some tax returns, some property tax records. It always boggles my mind that banks have to ask for this stuff continuously, even if you've already refinanced with them and gone through the mortgage process. Whatever. No ongoing fees for line of credit, which is nice. You just write checks against the house anytime you want to use it. So when you have those remodeling come in, don't get the appraisal done on your own unless the bank, or check with the bank first, because they'll probably want to use their own appraiser and have their own company. Side note, I have a real problem with appraisal companies. I haven't had a good experience with them in the past. They take the 10 houses that have sold in the last 3 months, and then they just average them. That's literally all they do.
Sounds like a job that will be replaced by AI.
It should be. Zillow is probably a better than the comps that they use. So once the appraisal is done, they'll tell you how much equity. And I've gone to war with some banks over the appraisals before because they're wildly off mark occasionally. And so I'm willing to get dirty and go to war for that kind of thing. Once the appraisal is done, they'll tell you, here's how much equity you can take out based on, how much it's worth and how much you owe. Little paperwork. They have like a closing, sign your name, and then they give you a checkbook and you're good to go. So much less pain than a refinancing. The process they tell me like 7 to 8 weeks, usually 6 to 8 weeks. So I would go through that process now in anticipation of the remodel. That way you know exactly how much you have to borrow, because likely that remodel is going to cost more than you think. It almost always does. So that way you know how much you have. You go through the process. You have that line of credit waiting for you. But check with the bank first on the appraisal. I wouldn't just go get one done yourself. They might want to use their own company, use theirs, or try to talk them into using yours because theirs probably stinks based on my experience. But yeah, go through the process, have that line of credit waiting. I'm going through the process right now. I mentioned my vacation home a couple of weeks ago. I got equity on it, and I said, why don't I take out a line of credit on this just to have it? Right, so I'm paying the fees, yes, but like after that, I have the line of credit there. It's waiting in case I want to buy a ton of oldie call options once it's down 96%.
Wait, bigger scam, title insurance or appraisers?
Oh, title insurance for sure.
Okay.
I'm sure there's above board appraisers out there. I've ran into a few of them that are not very good. That's been my experience. And I've gone to war.
Good for you. Fight him a good
Next
fight.
question.
Okay, up next we have a question from another John, but spelled without the H. As a 46-year-old man who's recently welcomed a child into the world, I'm now considering the necessity of life insurance. I've been exploring a 20-year, $1 million policy, but the premiums are around $250 a month. I've had some minor health issues, but I'm otherwise in excellent health. The dilemma I'm facing is my age and gender, which affect the cost of the policy. Do I purchase the plan and pay $250 a month for 20 years, totaling $60,000, or take my chances? My portfolio, taxable and retirement, is currently around $400,000. If something were to happen to me tomorrow, my daughter would get that. I currently contribute about $36,000 a year to my portfolio, and assuming an average annual return rate of 7%, my back-of-the-napkin math shows that I will be over $1 million in a little less than 10 years. Do I bite the bullet for peace of mind, or should I just invest that extra $250 a month and get to that $1 million mark sooner?
Really good question.
Yeah, I like
Let's bring on our resident insurance expert. He's a financial advisor. He helps run our insurance practice at Ritholtz Wealth. Jonathan Novy. Jonathan, I'm contractually obligated to say there's a lot to unpack here because there really is. I don't know where you want to start, but the one place I want to start, and this is the obvious thing to a guy who's not an insurance person, is saving that $250 a month for 20 years or whatever it is. The only problem with that is he could die between now and then. So that $250 a month is not necessarily guaranteed. That's the only thing. But I'm curious how you think about the cost benefit here, the pros and cons, the trade-offs, all that stuff that comes with this.
Sure. So first, John, congratulations on having a child. That's amazing. We wish you only the best. So when it comes to insurance, Ben, you're right. There's a lot here. When it comes to insurance, we always start in the same place. I've said it every time I've been on here, and I continue to say it to all of our clients. People buy insurance because there will be a financial impact on their family were they to die. What John's job is to figure out what that financial impact will be. So if his income goes away, if he can't support his family, he wants to leave money for his kid, measure the financial impact. And then if you're
right, insurance and investing are two completely different things.
Yes, they are. I hate, and I won't get bogged down in the conversations about things like buy term and invest the difference and that nonsense. I will largely die on the hill of insurance is not a vehicle you should use for the accumulation of cash surrender values to use later in your life. Insurance products are terrible for it, and I may catch some heat for that one, but it's the truth. They're just terrible, and I can prove it and all that stuff. They're just too expensive for the purpose of accumulating cash values later in your life.
Now, I get the sense that John here is just kind of scoffing at paying $250 a month for his insurance. Because when I signed up for mine, and I think I was 32 or 33 when my daughter was born, it was much cheaper. And I'm sure the older you get, obviously, that's the way that they look at this stuff and price it. He's right. It's going to be more expensive the older you are. So he's probably saying, God, I wish I would have just done this 10 years ago or something, and it would have been cheaper.
So there's two things going on here with what John is saying. First is, he refers to this as a dilemma. I'm sorry, John, but you don't have a dilemma. A dilemma refers to two bad choices that you have to choose from. You don't have bad choices. You just have choices.
Right.
You get to decide if this is something you want to do. So these aren't bad. It just happens to be where you are. What he's doing is anchoring to a price that never actually existed to insure himself to begin with. I don't know where he came up with he thinks it should be cheaper, because the reality is the insurance company has a right to say, if we're going to pay your family X amount of money were you to die, we need to try and make sure we don't go broke doing that.
So what do you think about the price here? So someone in their mid-40s, because this is like me. If I'm approaching here. If I try to get insurance today, I'm a relatively healthy guy. I'm mid-40s. I'd be paying more than I did 10 or 15 years ago. Like, is this $250 a month in the ballpark?
So I actually priced it up for a 46-year-old to see how to contextualize this price. That is the price of a substandard rating, meaning someone who is a substandard health risk. So that says something to me as someone who works in the insurance business.
So $250 is on the high side.
Yes, it is. So there's a couple ways, John, for you to think about this. First, if you're looking at, and this might well be happening, one of those insurance processes or carriers that you can apply online and they say, we'll issue you insurance in 5 minutes with almost no underwriting. All of those carriers, and they're not bad, I'm just saying this is what they do. All of those get insurance really quickly carriers have to price insurance at substandard ratings because they specifically do very, very little medical underwriting. or
makes sense.
predictive underwriting. So they have to make it expensive.
It's like a credit card has a higher rate. It's the same deal.
Is what it is. Now, if in fact John thinks that he's pretty healthy and shouldn't have insurance, like General's preferred or standard pricing for insurance taken away from him because he's got a health problem, go find an independent insurance producer or broker who is going to actually collect medical information, have you examined, and look at which carrier out there in the world would give you the best pricing.
Shop
Next.
around. I'm a big proponent of shopping around.
Yep. Next, and this is important. If John doesn't think that the risk goes for 20 years, because he says in this thing he's going to continue to invest $30-some thousand a year and he'll have more money in the future. It may not be that the risk exists for 20 years. It may be that it exists for 15 years or maybe for 10 years. So there's no one out there saying you have to buy 20 years of term insurance. Which brings us back to my original statement, in that people own insurance because there will be a financial, because there's a risk to their family were they to die or be disabled. If the risk goes away in 10 years or 15 years, then don't own the insurance past that.
Right. Yeah,
So-
if you're more comfortable where your finances are going to be, make it a shorter term.
Right. So, like I said, John, you do not have a dilemma. What you have are a series of actually not such bad choices.
Yeah, and it sounds like he's in a pretty good shape financially. He's saving almost 40 grand a year. He's
Yeah.
already got 6 figures saved. He's in a good position. So yeah, maybe he can get it down to, I don't know, 200 or 150 bucks a month, save the difference if
Sure,
he
I mean,
wants,
I
and then he's
just
doing a
looked
little
at-
bit of both.
Even at a substandard rate, because I did all the pricing, if it's a 10-year term insurance contract, he could cut $1,000 annually off that premium. Now all of a sudden, it's still $1 million of insurance, which he may decide right now he needs for his family. And there's plenty of stuff that we don't know just from looking at this simple question. We don't know
Right.
if he has a spouse that earns income also. We don't know anything beyond the simple bit of information he gave us here. So it's very difficult to do a proper needs analysis with a small paragraph. But based on what we know, there's plenty of stuff he could do to mitigate the risk he's got here.
Yeah. Good advice, though, like shopping around and checking, like, hey, price it out for me for these different terms. And I like that idea.
What point in life do most people drop their life insurance?
You'll forgive me for going back to what I always say. People buy insurance because there will be a financial impact on their family were they to die. When the impact of somebody's death goes away, you drop your life insurance.
Okay.
In a
Now-
movie, though, you change your insurance right before someone kills you.
That for sure. Or like you take it out right before you go skydiving. You know, we were talking about that before the show.
But so there's
You
not
know-
like most people, stop having life insurance at a certain
Yeah, I'm
age.
curious. Is there? But if you look at the actuarial tables, is it like you hit 45 and the price is just kind of? Is there a point where it just ramps up? Is there an age, or is it just kind of slowly escalate?
So pricing is non-linear. The older you get, the more expensive it becomes annually. So there's a curve to pricing. So if you bought, Ben, let's say you bought term insurance when you're 25 years old. The reason that it's super cheap is because mortality is still very, very light at age 45. But I just redid some of my insurance, and I'm 52. And I did it because I bought 20 years of term insurance almost 20 years ago. So I have to replace my insurance because I still need some. But now, if I buy 20 years of term insurance, I'm still insuring myself at age 70 because I'm 52 years old. Well, the costs of insuring someone annually are not linear. They curve because your mortality gets much higher annually as you get
Right.
older.
So what you did at 52 is what I'm going to have to do. That's when my 20-year term is basically going to come up.
Ben,
So you can
by
tell me how much
then-
I'm going to get bent over by the insurance company at that point too.
No, by then your target date funds will have made enough money where you're probably not going to have to worry.
True. That makes sense. Yeah, you're right. So yeah, okay.
Someone in the
Put it
chat's
down.
joking about that commercial that says you're sitting on a gold mine about your life insurance policy.
Yeah.
Oh, God. That
right.
stuff is just
Next one.
nauseating.
Yeah. All right. Up next, we have a question from Thomas. My wife and I have a 3% fixed rate mortgage on a $550,000 home. While the home was expensive, we live near New York City, so $550,000 didn't really go that far, and the house is small. We're now adding a substantial addition to make space for our third kid. since we just bought this house and we didn't have equity for a traditional HELOC, so we did a renovation loan for $225,000 at 9.75% variable rate.
Ouch.
I see our options as trying to pay off the 9.75% loan as fast as possible. We're lucky to have high-paying jobs, so we can afford to try to pay it down fast, or refinancing the whole thing and losing our 3% fixed rate to a new 7% rate on a much larger mortgage. Do you think this is a circumstance where it's worth it to pay down my high-rate mortgage? I doubt I could reliably make 9.75% in the stock market.
I mentioned this before, but it's funny how many
Sounds
of the
like a
questions...
challenge.
Well,
Sounds
it
like
is.
a challenge.
But how many of the questions we get are just life questions? Like
Right.
life forces your hand. And we're talking about remodeling because you have kids, you want to grow, and life insurance because you had a kid. It's most of these financial planning things come down to life getting in the way or happening. But that 9.75% is very high. The Fed cuts rates, that's probably not going to come down that much. So I'm just curious, Jonathan, when you're having conversations with clients, how is this higher hurdle rate for borrowing impacting financial decisions? Because if a few years ago rates were so low, it didn't really have to, it wasn't that much of a decision. It was kind of like, why would I pay this down? Rates are low. Now it's a different calculus.
We just happen to be faced with higher rates right now. And we see the challenge with this all the time. I mean, part of what you and Michael talk about all the time is that it's impossible to, or much harder to buy a house now than it was before because there's just not enough supply and borrowing rates are higher. Again, he has a series of choices. It seems to me that the best one would be pay down the variable rate loan as fast as you can and keep the 3% mortgage. Because if he's able to pay it down, if they both earn and they can pay it down quickly, that's probably the right thing to do. The annoying thing about variable rates is they're very, very quick to go up, and rarely do the banks make sure that they come down when rates come down as well. Banks just get to do that. But it's also not worth predicting where rates are going to go in the future. And you and I talked about this a little bit before the show. Don't ever kind of reach, and this is the advice we would give. And people who sell homes would tell you differently. Don't stretch on financing stuff like this, and don't bite off more than you can chew under the hope or the belief that rates are going to go lower, because you simply have no idea what is going to happen with rates. It doesn't matter what we think the Fed is going to do. Like, everyone's going to make predictions. Those always are going to go differently than you think they are, no matter what. And don't put yourself in a position where you can't pay for this loan in 3 years if rates don't go where you think they are.
Yes.
If he can afford this right now, pay it down as fast as you possibly can and keep the 3% mortgage. That 3% mortgage is incredible.
Yes. I'd be very against getting rid of the 3% mortgage regardless. And if you're paying this off over the course of 5 years or something, and rates happen to fall, and you could do a cash out refi at 4% during the next recession or something,
Sure.
Yeah, maybe think about it. But as of right now, that spread is so big, I would do everything I can to pay. And you can calculate too, how much am I paying in interest every year on this $225,000 loan at almost 10%? It's pretty easy to do the back of the envelope math on that and say, okay, if I pay it over 5 years, how much interest I'm doing, here's over 4 years. And I would think about it that way too, for how much actual interest are you paying? Because this is not a 30-year mortgage or something, I hope, that you're paying it off in a relatively short amount of time.
Also, I know we probably have people watching from across the country that are like, $550,000 house? That sounds pretty nice. For some perspective, I brought along this graphic showing how expensive a parking space in New York City is monthly. So just putting that in perspective for people, that 550 doesn't go nearly as far.
Is that all? And the bonus is you have to drive through New York as well to get that. I always look at the people driving through the city, and what is wrong with these people?
It's no fun.
My one experience driving in New York was when my brother moved to New York City years ago, and we packed all of his stuff up in one of those big, U-Haul trucks, and I was trying to get through New York City in one of those big U-Haul things. It was awful. Oh my gosh.
Yeah, I've been there.
I always say I don't know how people move from apartment to apartment in New York. I don't know how it's possible.
Very miserably.
I would just leave my stuff there. All right. Yep. One more question.
Okay, last but not least, we have a question from Daniel. Longtime grateful listener. I recently learned that from a Fidelity webinar that in a jointly held account, there's a step up in cost basis when the first spouse dies. First time I learned that, and it makes a huge difference in our estate planning since our main holding is 7 figures of Microsoft with a basis of 40 cents a share. Can you confirm and comment on whether this is widely known?
So I looked it up. Microsoft right now is trading at like $414 a share. So they have just a little bit of capital gains embedded in here. This seems too good to be true, and if it is, this could be a movie plot as well. Like someone who holds NVIDIA or Apple, right? They kill their spouse, so they get the step-up basis, don't have to pay the taxes. What can we confirm here on how this actually works?
Okay, so this is one of those things where when it comes to tax advice, you have to consult professionals. So I did. I spoke to the Bills, who've been on the show before to talk about taxes. I also talked to Gary Pulford, our estate planning person here. And conveniently enough, I am working with a new client who has this exact situation where they were gifted Microsoft shares from a parent years and years ago. And now they own a lot of Microsoft with almost no cost zero cost basis. So the information that the person who asked the question got, I'm not convinced is correct. So in a joint account situation, so if the husband and wife or the spouses own the Microsoft stock in a joint account, there is not a 100% step up upon death. There is a 50% step up. However,
it's not bad.
It's not bad. Were the assets owned separately, not in a joint account. So the people I'm working with each own theirs in a revocable living trust. With the assets owned that way, there will be a 100% step up on the first pass.
So it's a separate or joint. That's the difference.
Right. Next, it depends if you're also in a community property state. So in a community property state, there is a 100% step up on the first death. Shout out Gary Pulford on that one. So tax laws are different from state to state.
Okay.
And this is the kind of situation where make sure that you consult a professional on it. So largely we've given the right information here because I did consult professionals. Obviously, from one generation to the next, there is largely always a step up in basis depending on what you've done with the estate planning processes. There can be a step up in basis from one spouse to another, provided it is not owned jointly.
Okay, so the wife is no longer going to kill the husband in this situation because they only get a 50% step up. It's not worth it.
Well, definitely not because of the step up, might for other reasons.
Right, okay.
That reminds me of Barry's story about how cheaply he owned Apple back in the day and how he like doubled his money and thought, man, that was a great trade. That's kind of funny. 40
That's
cents
funny.
a share.
I've only heard him tell that story like a dozen, 100 times, maybe.
Hey, I've only heard it twice.
Good question. This is the stuff that's worth asking. But this is also the kind of thing you mentioned, Jonathan. Like sometimes a professional can help you with this stuff, and you don't want to just wing it with these kind of questions. But it's also good to ask these questions before you have to know about it, right? Some people ask it after the fact, and then they're playing catch up and trying to figure it out. And yeah, it's good to know now. But yeah, talk to someone, figure out what kind of state you're in.
Especially with estate planning considerations like this, the numbers get really big. And it's not the kind of stuff you want to get wrong.
Yes. Well, especially on a 7-figure stock that has basically 95% of it, 98% of it is gains.
Right. Yeah. I mean, that's a big tax bill. So, and here, I mean, there's only trade-offs in a situation like this. I mean, how do you could have 20 years for someone to continue to own this. And is it worth it to hold on to a concentrated position for that long if you're worried about the risk of a concentrated position?
That's true. Yeah.
Could you be pay the tax, or is it better to diversify? And all of that has to be contextualized in someone's individual.
And as Bill always reminds people, I'm sure it seems like this thing hanging over them that they have to pay taxes on this huge gain, but the alternative is you didn't make any money. You know.
Yeah, I mean, guy won the game already. It's like start to play a different one.
Yes, they won. So perfect, good stuff. Thank you, Jonathan, for your wisdom.
Thank you, guys.
As usual, remember, email us, askthecompoundshow@gmail.com.
Rate and review.
Yep, rate and review, subscribe, all that good stuff. Keep Duncan happy, and we will see you next week.
See you, everyone.
See you guys.